The Navitas Semiconductor NVTS stock price closed at $18.20 as of Friday, May 8, 2026 at 4 p.m. EDT, marking a massive intraday surge of 15.26%. While the market is currently closed this Sunday morning, May 10th, the momentum from the latest session is still vibrating through the trading community. This sudden vertical movement in the Navitas Semiconductor stock price has caught many off guard, especially those who were looking at the quarterly earnings miss as a reason to stay away. The expectation was that a 200% miss on earnings per share would drag the ticker into the dirt, but the reality is that the market chose to focus on a 5% revenue surprise and an aggressive sequential growth outlook. This is the classic tension between a trailing balance sheet and a forward-looking growth narrative. Investors often get trapped looking at the net loss, while smart money is looking at the 35% year-over-year growth in high-power markets. If you are currently holding positions through platforms like Robinhood or Interactive Brokers, you know that the semiconductor sector is currently a house of mirrors. The general belief is that if a company isn't NVIDIA stock or maybe AMD, it's just a secondary player fighting for scraps. I'm here to challenge that common ground. Navitas is effectively building the specialized electrical plumbing for the AI data centers that NVIDIA stock powers. While the big names get the glory, the hardware that manages high-voltage power delivery is where the actual bottleneck for AI scaling exists. The surge we saw on Friday wasn't just a random rally. It was an institutional acknowledgement that Navitas is successfully pivoting away from the low-margin mobile charger business toward the high-margin AI infrastructure space. Trading volume on Friday was through the roof, hitting nearly 35 million shares compared to the much lower daily averages we've seen earlier this year. This kind of volume indicates that this wasn't just retail excitement on the Robinhood app, it was heavy institutional accumulation. When you see a stock gap up like this despite a technical earnings miss, it tells you the narrative has shifted from "can they survive" to "how fast can they scale." For those of you managing your own portfolios through Schwab Intelligent Portfolios or a Fidelity brokerage account, this is a clear example of why price action often leads the news. The technicals are showing a breakout from a long consolidation phase, and the stock is now testing levels it hasn't seen in months. Looking at the internal mechanics of this movement, the strategic realignment labeled as Navitas 2.0 is the core driver. For a long time, Navitas was viewed as a phone charger company because their Gallium Nitride chips were primarily used in fast chargers for mobile devices. That market is a race to the bottom on price. The reality that the market is now pricing in is their dominance in silicon carbide and high-voltage solutions for data centers and the energy grid. This is a massive leap in market value. They are targeting a $3.5 billion addressable market by 2030, and the fact that they grew their high-power business by 25% year-over-year while cutting operating expenses by 13% shows a lean, aggressive path toward break-even profitability. The recent appointment of industry veterans to the board and the promotion of Tanya Stevens to CFO also signals a transition from a startup mentality to a mature corporate structure. Institutional investors look for these signals before committing large blocks of capital. If you're doing online investing via SoFi Invest or Interactive Brokers, you've likely noticed the surge in semiconductor ETFs as well. Navitas is increasingly becoming a staple in these niche funds because they offer a pure play on power efficiency in the AI stack. Every rack of AI servers needs massive amounts of power, and managing that heat and voltage efficiently is exactly what Navitas does. At this point, I want to hear from you. Comment below with how many shares of Navitas Semiconductor you currently hold, or if you think the shift from mobile to high-power data centers is enough to sustain this rally throughout 2026. Your engagement helps us see where the sentiment is shifting in real time. Now, we have to look at the business model objectively. Navitas operates in the next-generation power semiconductor space, specifically focusing on gallium nitride and silicon carbide. These materials allow for smaller, faster, and more efficient power conversion than traditional silicon. While the company has seen its revenue dip from $14 million a year ago to $8.6 million recently, this was a deliberate choice to exit low-margin consumer contracts. This is a bold move that many companies are too afraid to make. They chose to shrink their top line to improve the quality of their earnings. The gross margins improved to 39% on a non-GAAP basis, which is the reality that outperformed the expectation of continued margin decay. Historically, Navitas has been a volatile play. If you look back at the 2025 performance, the stock was languishing in the single digits for most of the year as they struggled with the transition. However, the first quarter of 2026 has marked a definitive turning point. They are now projecting $10 million in revenue for the next quarter, which would be 16% sequential growth. This kind of consistency is what builds trust with wealth management platforms and individual brokerage users alike. Whether you are using Fidelity IRAs for long-term holds or Robinhood stock trading for short-term swings, the volatility here is a double-edged sword. The future outlook for Navitas is intrinsically tied to the pace of AI data center expansion. If the demand for AI compute continues to grow at its current 60% compound annual growth rate, Navitas is positioned as a primary beneficiary. The risk, of course, is competition from much larger incumbents like Infineon or onsemi. However, Navitas has a first-mover advantage in some of these highly integrated GaN power ICs. They aren't just selling chips, they're selling entire power platforms that reduce the print footprint of a data center power supply by half. In the world of high-density computing, space is at a premium. We also have to consider the macroeconomic pressures. High interest rates have historically hurt small-cap tech companies that aren't yet profitable. Navitas is still burning cash, though at a reduced rate. They ended the quarter with $221 million in cash and zero debt. This gives them a significant runway to reach that break-even point without needing to dilute shareholders with a secondary offering. For those of you focused on self-investing or using investing sites to track fundamentals, the cash position is perhaps the most underrated part of the Navitas story. They have the flexibility to weather a temporary downturn in the chip cycle while continuing to fund research and development for their 800V AI power platforms. Expectations for the rest of the year are set high. The market expects the gross margin to cross the 40% mark by the end of 2026. If they hit this, the valuation could re-rate significantly higher as they move closer to being a profitable entity. The reality of the semiconductor industry is that it is cyclical and brutal, but the secular trend towards electrification and AI efficiency is a tailwind that is hard to ignore. If you are looking for investment help or exploring individual brokerage options, keeping an eye on these high-power semiconductors is essential. To summarize the landscape, Navitas Semiconductor is no longer just a mobile accessory story. It has evolved into a critical component of the AI infrastructure. The Friday close at $18.20 was a powerful statement from the bulls, effectively ignoring a quarterly loss in favor of a bright, high-power future. We saw a clash between the expectation of a post-earnings drop and the reality of a strategic pivot that is actually working. The curiosity loop for investors now is whether they can maintain this 16% sequential growth rate into the summer. The authority of the Navitas 2.0 strategy is being tested in real time. They have proven they can grow the segments that matter while trimming the fat from their legacy business. As we move into the second half of 2026, the focus will remain on their ability to capture a larger share of the AI data center market. Whether you're an active trader on the Robinhood app or a long-term investor with Fidelity Wealth Management, the story here is one of high-stakes transformation. The market has given them a vote of confidence with this latest price action, and now it is up to the management team to execute on their guidance. The gap between what people thought Navitas was and what it is becoming is closing, and those who recognize the shift early are the ones seeing the most significant returns. Keep a close watch on the daily volume and institutional filings in the coming weeks to see if this trend has the legs to push toward new all-time highs. For now, the momentum is clearly on the side of the innovators. Disclaimer. This video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, outshare with your friends, bell subscribe for more updates.